Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for April 12th, 2021. We have Josh Steiner joining today. Keith, again, is on vacation, a well-earned vacation with his family this week, so we're going to have various sector heads joining in on the Macro Show this week. But before we hand it off to Josh, we'll go through the top three things, which are in this order: China, oil, and the U.S. 10-year yield. So for China, it's not quad 2 in China, it's quad 3. We've been signaling this for a while. Quad 3 stagflation for the Chinese economy, with a modal outcome of the same stagflation quad for the next 3 quarters. So we're going to see sort of a persistence of this trend. Stocks down another 1% in Shanghai overnight, continues to signal bearish Hedgeye trend. We also had some interesting data out of China this morning, which showed loan growth starting to slow. So we're seeing sort of a softening in monetary policy in China. Number 2 is oil. Consolidation signals last week within oil's bullish Hedgeye trend, and oil volatility breaking down below 39 this morning. So that's positive for the price of oil. We like when volatility goes lower in asset classes, and oil obviously has had a huge rip this year. We continue to think there are buying opportunities on the equity side in oil. XLE, XOP, some of the larger cap names are ideas or exposures we like. The last thing is the U.S. 10-year yield. Textbook bounce off the low end of our Hedgeye risk range, which is 1.63% to 1.78% last week. Big data point tomorrow, U.S. inflation report. So the CPI is due out tomorrow morning. We've been talking about this a little bit, but you can sort of see the precursor for CPI from prices from other parts of the economy. So we would expect that CPI will accelerate, might not accelerate meaningfully tomorrow, but over the next couple months you will see a pretty meaningful acceleration in CPI. And with that, we'll hand it over to you, Josh. Thanks.
So thought today we'd take a look at the U.S. housing space, try to put it in context, both where it's sort of been, where it is, and of course where it's headed. So we put together a couple of slides here, maybe more than a couple, and I thought we'd run through those in turn. And when we get through it, if people sort of want to dig into it more, we can go through that in the Q&A. So we'll start here on slide 9 with a quick look back first at 2020. So, pretty remarkable year, 2020. Obviously, COVID was the dominant factor, but to put in context the sort of bipolar nature of housing equities, just in the first half of last year, housing equities had both their best and worst performance of the last 20 years from a quarterly standpoint, just in the first half of 2020. So you can see the chart at the top there basically shows the big housing ETFs, ITB, XHB, the S15 Home Index, all down between 30 and 40% just in the first quarter alone, basically leading the broader index to the downside, save only the XLE, which is energy. Then once you got to the next 9 months of 2020, it was the complete other side of the story. So best performing sectors in the market overall, top of the stack. And you can see over on the far right sort of how that looked on a quarter by quarter basis. Now, if we turn to slide 10 and take a look at the start of 2021, here's the same thing, but now we're looking at the first quarter of 21. And the story is largely the same, or has been the same in the first quarter as it was in the last 9 months of last year. Maybe the one exception being that energy has sort of raced to the front of the pack, but clearly ITB, XHB, and S15 Home have continued their winning ways, and interestingly, actually put up their best first quarter in the last 20 years. So if you look at the table on the right there, you'll see they were up 25.5%. That's the best performance they've had going back to 1999 in the first quarter. Fundamentally, if we go to next slide here, slide 11, it's a pretty interesting dynamic. If we had looked at this table, and this is basically just a rate of change heat map table across the various fundamental categories within housing, as recently as 2 months ago, this was just a wall of green. But obviously, things are beginning to roll over, slow down from a rate of change standpoint. You can see that a little bit more clearly here on the next slide. So This will give you a little bit more context. Now we're going back to sort of early 2018. I won't go through all of these sort of periods, but maybe start kind of, the period coming into COVID was actually a pretty strong period for housing. So you can see that sort of green rectangle there, pre-COVID cliff, where you had generally improving fundamentals, improving demand. You had rates coming down on the margin. You had an easier comp setup, sort of comping up against the rate shock environment that had sort of characterized 2018. And then, of course, the COVID cliff hit, and we basically dropped precipitously in the months of March, April, and May, before really seeing a profound recovery in the housing market on the back of all-time low rates, the sort of work from home deurbanization movement, and just organic improvement. If we go to the next slide, slide 13, one of the big things that's been sort of happening in the housing market, you're seeing it a lot in the news now, but really it's a trend that's been underway for a long time, is this sort of growing shortage of inventory of homes for sale. So to put this in better context, this chart goes back to 1984, and it's looking specifically at single family homes. And we're looking at months supply of inventory. So, and this is not seasonally adjusted data. So each year you tend to see these sort of spikes due to that seasonality. But, if you zoom out, you can really get a sense for the context here. So basically in the late 90s, early 2000s, you had this environment that was kind of characterized by 4 to 5 months supply. Then the financial crisis hit, and of course, month supply of inventory exploded up into double digits. We got to 10, even 11 months supply. Really hadn't been at those levels since the sort of early to mid 1980s. Then coming off of that, largely on the back of just a profound slowdown in new home construction, you had this slow but steady tapering off of supply. And then really in the sort of 2014, 15, 16, 17 timeframe, it was sort of sideways but down a little. And then COVID hit, and all of a sudden we've sort of come to a completely new environment. To put in perspective how low 1.9 months of supply is, maybe numbers that are a little bit more tangible. Normally, in the early part of the year, like January, February, if you look back over the last 2, 3, 4, 5 years, you would have anywhere from 1 million to 1.2 million homes on the market for sale. As of this year, that number was 500,000. So there is less than half of the normal inventory of homes for sale out there right now. And as a consequence, if we go to the next slide, they are just flying off the shelf nationally. So this is Redfin data that shows the percent of homes off the market in 2 weeks. And obviously this is not seasonally adjusted data. So you can see that it tends to peak early in the year and then steadily decline through the end of the year. And then you get all the spring selling season listings that come back onto the market. But the point is that in previous years, in the early months of the year, January, February, March, you've tended to be in this sort of 40 to 45% of homes sell within 2 weeks. As of the latest data, which is March of 21, that number had risen to 61%. So almost 2 out of every 3 homes, or at least 3 out of every 5 homes, are selling within 2 weeks of being listed. So just an extraordinary environment. This has all given rise, if we move to slide 15, to the fastest rate of home price appreciation that we've seen on record. So this is the FHFA, Federal Housing Finance Authority, that basically oversees Fannie Mae and Freddie Mac. And really what you're looking at here is an RSI, or repeat sales index. In other words, these are sales of the same home over time. And the other sort of thing to realize is that this would look only at GSE eligible, AKA conforming homes. So basically homes that fall within the GSE lending caps. So nothing jumbo. But what it shows is that as of the latest data, which is February, we are running nationally at 12.03% home price appreciation, i.e. growth year over year. That's actually the fastest clip we've seen really in the history of this series going back about 25 years, and even now eclipses the peak that we saw in the housing bubble run-up phase there in 2005. So pretty extraordinary pace of appreciation, and that's really not a huge surprise given what we just looked at from an inventory standpoint. If we go to the next slide here and we look at what is driving this and what has been driving this over the past year, it's really the high end. So we've seen the strongest growth in expensive homes, and these are largely second homes, in some cases third homes, fourth homes. But homes over $1 million, sales are up 81% year over year. That's through February of this year. Next year down $750,000 to $1 million, up 66%, and $500,000 to $750,000, up 50%. And interestingly, at the other end of the spectrum, homes $250,000 or less are actually down year over year. And we've got a little comment there at the bottom of the slide that points out that second home sales for February of this year, so in other words, this trend is still happening, are up 93% year over year, whereas sales of primary homes are up 32% year over year. So that should give you a little bit of an idea of the sort of bifurcation or K-shaped dynamic of the housing market, at least these last 12 months. One of the reasons why, if we go to the next slide, slide 17, is that underwriting standards have conspicuously tightened. So the chart on the right is sort of the longer term snapshot of underwriting standards back to mid-2004. And these come from the Mortgage Bankers Association. This series is called the MCAI, or the Mortgage Credit Availability Index. It's basically sort of an indexed representation of how easy or difficult it is to get a mortgage. So if the index is high, that means that it's very easy to get a mortgage. If it's low, it's very difficult to get a mortgage. And so you can see back in the heady days of the housing bubble years, when subprime was gold, how easy it was to get a mortgage, and then of course how difficult it became. If we go to the slide on the left, which really begins in sort of mid-2011, there's a little bit of a zoomed-in view. You can see that over really the 2012 through early 2020 timeframe, mortgage credit availability had generally been improving each year until all of a sudden COVID hit and underwriting conditions tightened very quickly, very aggressively. So part of that is the natural response to the pandemic, but part of it is also the head of FIFA, his name is Mark Calabria, has been looking to really tighten the screws on the GSE's footprint for years. Now remember that Fannie and Freddie still fund more than half of the mortgages in the US, so they still play an enormous role, and he's in charge from a regulatory standpoint. And so he can really dictate what they can and cannot do in terms of underwriting. And so he had been sort of looking to aggressively shrink their role in the housing market. And at the same time that COVID hit, the underwriting standards compressed dramatically. So I don't think that's entirely coincidence. But anyway, the point is that when you constrict underwriting standards to this extent, what it means is that it becomes much more difficult to obtain a mortgage. Therefore, really the only people who are able to buy homes are high credit quality borrowers. So a lot of would-be first-time home buyers largely get sort of left behind, left out of the market. And so what's interesting about that, if we go to the next slide, is that this millennial generation is really getting into what should be their sort of peak home buying years, first-time home buyer years. And what I mean by that is that pre-COVID, the average age of the first-time home buyer was about 32 to 33 years old. Now that's older than it had been. If you went back about a decade and a half prior to that, people on average were buying their first home in their late 20s, around 27, 28, 29. But post the GFC, that sort of extended out in duration. Now, part of that's student loans, part of that's people just sort of taking longer to settle in and so forth. But the bottom line is that on average, pre-COVID, people were buying their first home on average at 32 to 33. And so if you look at that chart, what we're showing is the number of people by age in the US. So there are 4.5 million 33-year-olds as of 2021. Whereas there are almost 4.9 million 30-year-olds in 2021. So again, 32 to 33 is the average age at which people would normally buy their first home. And you can see that for the next 2, 3, 4 years, the number of people who are turning 32, turning 33 is going to go up steadily. So you're going to have this significant demand wave coming through at the low end of the market, people buying their first home. And on top of that, as we just looked at, there's a pretty big ball underwater dynamic here in the context of all of the 32 and 33-year-olds in the year 2020 and so far in 2021 who would have bought their first home but couldn't because underwriting standards tightened so dramatically and because the inventory is now so low. And so that sets up an environment that we think over the longer term is going to paint a very favorable backdrop fundamentally for the housing space. And just to put it, one final piece of context on this, the Generation X group is about 65 million individuals. It's a relatively small generational group. The millennial generation, by contrast, is 95 million, so almost 50% larger. It is a massive generation. And as that, it's much larger than the baby boomer generation ever was. And so as that generation rolls through these demographic waves, right? So when they hit their early 30s, they buy a house. Over the next 10 to 15 years, they start investing more aggressively, saving for retirement, et cetera. They're just going to have an enormous effect on really everything that they touch from a life cycle standpoint. So going to be really important and interesting to kind of measure and map their flow through the future as they age up. If we go to the next slide, in spite of rising rates, which are up a little over 50 basis points for a 30-year fixed rate mortgage since early January, buyer confidence for new homes is just ripping. We use the word or the adjective cartoonish to describe some of these charts that we've seen here in this sort of reopening dynamic, and this is one of them. So this is, again, consumer confidence specifically related to purchasing new homes, and you can just see how it has literally shot higher here just in the latest reading. So the appetite out there for buying new homes is very strong. So I guess we have to sort of take and cover both sides of the dynamic, and this is no exception. So if we go to next slide, slide 20, the risk here with housing and housing equities in particular is that rates are now rising. So in the Treasury market, they've been rising since August last year. They've risen well over 100 basis points. But in the mortgage market, they've only begun rising more recently. So January 7th was the low water mark. You hit, I think, 263 on the 30-year fixed rate mortgage. We're now up to 317. So we're up about half of what Treasury yields are up. But that's not a dynamic that's likely to continue going forward. I think instead what you should expect is that you should get roughly a basis point for basis point move between the 30-year fixed rate mortgage and the 10-year Treasury yield. And that has to do with sort of a compression of what's called the MBS OAS, which basically caused a dislocation really through sort of the last 4 months, 5 months of 2020, but had essentially fully mean reverted by early 2021. If we go to slide 21, you can sort of see historically the role that rising rates have played when we get these sort of expedited rate shocks fundamentally in the housing market. So if we look back to early 1990s, October 93 to December 94, in a 14-month span, you had rates back up about 230, 240 basis points. Sales of existing homes dropped about 20% during that time frame. Fast forward to October 98 to May 2000, you had a 180 basis point move over 19 months. Sales of existing homes dropped about 6%. In the taper tantrum from December 12 to September of 13, rates moved up 120 basis points. Home sales actually moved up during that period, but then immediately at the end of it, home sales dropped very significantly, actually by more than the 6% that they rose by, about double that amount. And then in the most recent episode, which was September 17 to November of 2018, rates were up about 100, 110 basis points, and home sales declined about 7%. So that's sort of the fundamental effect of rate moves that tend to be sort of in the triple digit territory. And then if we look at housing equities, at least historically, slide 22, you can see there that the absolute performance of housing equities has been pretty poor in these prior rate shock periods. So down 33, down 29, down 3, down 34, but actually on a relative basis, much worse. So relative to the S&P 500, down 33, down 73, down 22, and down 26. So there's been an average relative underperformance of the market of 40 percentage points during these sharp rate shock periods. And so, it's sort of striking to sort of have this historical context and backdrop. And at the same time, in the sort of first quarter, as we touched on earlier, you've had the strongest equity price performance in the housing space of any Q1 going back at least to 1999. And so, what's that all about? Well, I think the basic dynamic here is that, when you have very strong secular environments, they can, and sometimes and often do, trump the quad setup. And so that's where the signals come in. The housing ETFs, ITB and XHB, are still bullish trade and bullish trend on Keith's models. And that's really how you sort of interweave the process. So the quads give you some framework, some context, as we can see here on the next slide, slide 23. So historically, quad 1 and quad 4 have been the best environments for housing. Quads 2 and quad 3 have generally been not great. Actually, the quad 3 environment, stagflation, has really been the worst. And we get a little bit more nuance there on the right. So when you have these sort of quad 2 Fed on hold and quad 2 to quad 2 transition points, housing's actually performed a little bit better in quad 2 than sort of quad 2 overall. So up 3.9 and 2.6% on average respectively. So, just a little bit of framework there for thinking about the housing setup. So, to kind of pull it all together on the next slide, maybe start. So these are kind of the conclusions and how to sort of think about pros and cons over the short to intermediate term and to an extent the longer term. So starting on the right with the negatives, obviously rates are rising. We're in this sort of protracted reflationary quad 2 macro environment, which is obviously going to keep the pressure to the upside on rates. The other thing we haven't touched on is that builders are facing just an extraordinary increase of cost inputs. So lumber is the most conspicuous, up 224%, actually almost 250% now year over year. I was talking with a contractor yesterday anecdotally, and he was telling me that a year ago, a sheet of plywood, a 4x8 sheet of plywood, was $15, and now it's $50. So that's pretty significant inflation. And so that's another factor, is that, and it's not just lumber, it's really a lot of the sort of core inputs to the home construction process have gone up significantly in cost. So that's putting pressure on builders. They're passing through certainly a lot of that. The question is, how much ultimately of that can be passed through. Other negatives, obviously, quad 2 historically has backtested very poorly for housing stocks. And then the comp setup is basically as follows. You are going to have very easy April-May comps here, because that's going to represent the low water mark from the COVID cliff. But then beginning in June and really rolling through the end of 2021, we're going to start going up against progressively more difficult comps. And then that tight underwriting environment is really an environment that's going to persist likely until Mark Calabria, the current head of FIFA, is replaced by the Biden administration, presumably with someone who would be more akin to Calabria's predecessor, Mel Watt, who generally was very easy or promoted a very easy underwriting policy. On the positive side, you've got this sort of constrained upside vis-a-vis this very limited existing home inventory. So we talked about the fact that you're at all-time lows of existing inventory. Well, if you think about the biggest competitor for new homes, it's existing homes. And if there are roughly half the number of existing homes for sale as there normally are, you really couldn't ask for a bigger tailwind as a new home builder. And then another positive is this work from home deurbanization dynamic. So, about 5 months ago, I was going through some survey work where people were asked, if pre-COVID you worked in the office 5 days per week, how many days per week do you expect to work in the office post-COVID? and 40% said just 1 day or 2 days per week. So this work from home dynamic is really going to stick around for a long time in very large numbers. And I think that's going to give rise to this ongoing de-urbanization push. So it's not to say cities are dead, but people are going to look to sort of sunnier, bigger, opener spaces in increasing numbers, and that trend is going to continue for a while. The other positive that we touched on is obviously the demographic one, which is millennials. So there's a big wave coming through on that front. And then just low inventory and fast home price appreciation. So obviously those are positives. So that's really what I wanted to touch on the housing front. I did have a few more slides in here that I thought were kind of interesting, more sort of food for thought than anything else. So if we go to slide 25, I thought it'd be fun to spend just a couple of minutes talking about the crypto environment. So, we've got a great Gandhi quote here that I think most people are familiar with. First they ignore you, then they laugh at you, then they fight you, then you win. So we sort of transformed that into kind of a modern day, Bitcoin. Starting at the top, we've got Morgan Stanley there, basically saying that its real value could be zero. And then more recently, Morgan Stanley becomes the first big US bank to offer its wealthy clients access to Bitcoin. Then you've got JP Morgan saying that Bitcoin is a fraud that will blow up. Of course, Jamie Dimon. Then you've got more recently, JP Morgan says investors could make Bitcoin 1% of their portfolios, and so on and so forth. Goldman Sachs, PayPal, Visa, Deutsche Bank, ING, et cetera. So one interesting thing to note, I was doing a little very simple back of the envelope math, and I was looking at, so the current market value of Bitcoin is $1.26 trillion. At a price of around 60,000 per Bitcoin, and 21 million is sort of the full float, fully diluted float, which we're not there yet, but we will be eventually. To put that in perspective, if you add up the market caps of the biggest four banks in the US, JP Morgan, B of A, Citi, and Wells Fargo, their combined value is about 1.16 trillion. So Bitcoin's now worth more than the four largest banks in the United States. Another way of looking at it is if you think of Bitcoin as sort of a payments platform, the combined value of Visa, MasterCard, PayPal, and Square is around 1.2 trillion. So again, Bitcoin is now worth more than Visa, MasterCard, PayPal, and Square combined. So obviously it's a real thing. It's not going away anytime soon, especially now that we've reached this sort of 2.0 phase, which is institutional embrace and institutional adoption. So, they can no longer ignore you. They can no longer laugh at you. They've lost the fight, and now they are embracing the future crypto state. So with that in mind, going to slide 26 here, I thought this was kind of an interesting thing that I had sort of come across. So, if you went back to gold in the early 2000s, so the first gold ETF was actually introduced in November of 2004. And at that time, gold was worth $450 an ounce. And then over the following 7 years, gold rose over 300%. So it basically quadrupled in value to just shy of $1,900 an ounce. So it took about 7 years. But what's interesting is this idea that, the sort of advent of this gold ETF really broadened out the opportunity set for traditional investors to own gold without actually having to buy the physical metal. So that was kind of new, that was novel. So the reason I bring that up is because with Bitcoin, I think younger people are generally not averse at all to opening accounts on exchanges and whatnot and buying crypto. But I think older generations, still where the bulk of assets reside, are. And then if you look from a legal standpoint, RIAs, which control most of those funds, are not able to invest in Bitcoin. So, and there are some publicly traded sort of either direct or indirect Bitcoin proxies out there in the US, but none are sort of an ideal fit. I guess the closest would be Grayscale's, but that's still not great. But there are currently 6 Bitcoin ETF applications pending with the SEC. Now, there have been Bitcoin ETF applications in the past, and they've all been denied. But what's interesting about this time and why it might be different is that Gary Gensler, former Goldman alum, former CFTC chairman, is the nominee to run the SEC. And he's been confirmed by the Senate committee and now faces the broader Senate vote, which I believe is likely to happen pretty soon. And by all accounts, it seems like he's going to be confirmed. And the reason that's interesting is because Gary Gensler is incredibly familiar with crypto. So he actually taught courses on blockchain and crypto and Bitcoin at MIT as recently as past couple of years. So, presumably him coming on board at the SEC may very well grease the skids for this Bitcoin ETF launch. Again, there are 6 applications pending from different money managers to launch Bitcoin ETFs. And again, going back to this gold example, the gold ETF GLD came out in November of 2004. Gold was $450 an ounce. 7 years later, it's $1,876 an ounce. So we think that that's all quite interesting. And then as a final point on that, again, this is our slide from earlier, slide 27. But again, think about the demographic tailwinds. So millennials are incredibly technologically comfortable. They are probably going to be looking at Bitcoin in lieu of gold over these next 5, 10, 15, 20 years, basically digital gold. And there are a lot of them, and they are going to obviously increase their earnings and their net worth dramatically over these next 5, 10, 15, 20 years. So that brings us to our final slide, slide 28, crypto inflows. I'll leave it at that. DJ, I'll hand it back to you.
Okay, great. I'm going to go a little overtime here, take a few questions for Josh. First one's actually a macro question, which I'll hit on. This is the number one question. Can you share your take on India, buy the dip or wait? So, those of you that have been watching the markets, obviously the Sensex is, when I was coming in, is down about 3%. The big thing that's happening over in India, of course, is a spike in COVID cases. I think the last 24 hours, we saw almost 170,000 new COVID cases in India. And, we've been watching the global COVID cases for a while. And the Indian data is not great, but the reality is on a rate of change basis, it's definitely accelerating. We're at new highs. The key driver of that, of course, versus a lot of countries in the West, like the US, the UK, and even Europe is starting to get better at this, but vaccinations in India are quite low, about 7 per 100 people. So without the vaccination base, you have wider spread. We also had a soft economic data point from Asia, and I think this is, from India, and I think this is sort of, as we saw COVID start to accelerate, you start to saw the economy soften a bit, but this is the manufacturing PMI in March was 55.4, which is a deceleration from February, which was 57.5. So what to do? We obviously have it in ETF Pro. Historically, obviously, this is the context. Every COVID headline has been a freak. Every COVID freakout headline has been a buy. But there's a cycle within the cycle, which is cases accelerate. If they accelerate enough, economy shut down, economic data softens, etc. I think this is one to wait and watch. I will say, as it relates to our quantitative signals, we need more confirmation before we would, tell you to buy more, tell you to sell. On a trade basis, that's three days. On a trend basis, that's 3 weeks or more. But I think today, this morning, it's down 3%. Why not wait and watch and see what happens? There's no change in our call at this point, but I think there are a lot of things to watch in India. So we'll move over to some questions for Josh. This is the number one question. Forbearance rules in the U.S. have distorted the statistics. Forbearance rules in the U.S. have distorted the statistics. Supply constraint by how much, and when do the evictions and repossessions start?
Okay, yeah. So, this has been a case of basically just perpetual kicking of the can. The latest on this is that the CFPB, the Consumer Financial Protection Bureau, has issued a notice of proposed rulemaking. So it's not a final rule, but they are proposing to prevent foreclosures through the end of 2021. So basically kicking things out into 2022. Now, there was a lot of forbearances that were going to come up for expiration in the third quarter of this year. So there was permission basically to go a full 12 months on government forbearance programs. A lot of those were, again, poised to expire in the August-September timeframe. So the CFPB is essentially looking to push those out beyond December into January of next year. And, as I think we've talked about a lot in the last few weeks, months, with Yellen at the Treasury, Powell at the Fed, I think there's going to be tremendous, and obviously the administration at large, I think there's going to be tremendous ongoing support to continue to make as much accommodation as possible available to these people. So ultimately, yes, there is a large bolus of forbearance people who are ultimately going to, unfortunately, pass through into foreclosure. But that is probably going to be a 2022 event and not a 2021 event. So I don't think that's something we need to be thinking about, at least in the intermediate term.
Okay, we're going to hit a few more here. Bunch of questions on when the rate of change, I guess, decelerates, or when do things peak and start turning over. So I'll ask this question. This is Alex from Toronto. Steiner, do you see housing prices and rate of changes hitting an inflection point and coming back down as we move into a post-COVID time series? Are the prices getting a bit ahead of their boots?
They are a bit ahead of their ski tips, that's for sure. Look, we're at an all-time high in rate of change terms, over 12% on FIFA. And actually, if you look at optimal blue data, which looks at home prices based on rate lock, so it's a much more leading indicator, those numbers are actually going to push higher still. We're probably going to get up into the 13, 14% range. We might even get a 15 handle. We'll have to see. But ultimately, I don't think that's sustainable. The single biggest thing to think about is really sort of the confluence of rates and inventory, right? So ultimately, inventory is a massive gating factor. We've looked at sort of distributions going back 20 years at inventory based on what decile it's in, of the historical context, and what kind of forward home price appreciation you get based on those inventory deciles. And when you're in your lowest decile, which at an all-time low, obviously we are, you've tended to see home price appreciation of 10, 11, 12%. So this is not really sort of surprising. I think the real question is not so much what's the outlook for rate of change in home prices, but what's the outlook for inventory. And at least based on the survey data, so there's a couple of different surveys out there that ask people about their intent to sell, to list and sell. And the numbers that we've seen there don't really show any kind of reversal of the trend that we're on, the path that we're on. So I think, it's a little bit hard to imagine these numbers enduring, meaning 12, 13, 14% home price appreciation. But if inventory stays as low as it is, and again, you've got that massive demand wave coming from the millennial cohort at the lower end of the market, I think you're going to have pretty strong home price environment for a number of years to come. I don't think that's going to change much.
And then obviously you have the what you've talked about, the component of potential student debt being absolved, and then the home tax credit. So you have this cohort basically having lower monthly payments on their debt, if no monthly payments, and then they get a credit for actually buying a house. So you have this.
That could be the additional sort of double whammy to the upside, is that this year, probably in the back half, if we get the student loan forgiveness, which looks like it's going to come in somewhere between $10,000 and $50,000 per borrower, coupled with as much as $15,000 in down payment assistance for first-time home buyers, and this acute lack of inventory of homes for sale. You can kind of do the math on that and think about what the environment's going to be like for housing well into 2022.
Okay. So Josh, we're going to wrap it up with one stock pick. I know I'm putting you on the spot because you're thinking more macro this morning, but what's a stock either you like here, or maybe you'd be short here?
Yeah, so our two most recent ideas are, both sort of in the payment space. On the long side, there's a small cap payments company called Paya, which is basically this sort of middle markets focused. It's kind of like a duck-billed platypus in the payments world. It's not like a large enterprise provider. It's not like a small business provider. They're kind of right in the middle. And it's come public through a SPAC late last year. And I think partly for that reason, the stock's been a bit of a laggard lately because most of the SPAC complex has been getting sort of thrown out. But I think this is kind of a classic case of the baby getting thrown out of the bathwater. Like, it's a good company. It's going to be a steady grower, and ultimately, we think there's a pretty high likelihood that this company could be acquired down the road. There's a tremendous amount of consolidation in the space. On the short side, a name that we've recently put out there is Affirm. Affirm is the largest buy now, pay later provider in the US. We do like the BNPL, buy now, pay later space, for really the same reasons we've talked about here earlier, which is that millennials like it, and there is going to be growing adoption. But the problem is that Affirm portfolios a lot of these loans, and a lot of these loans are very subprime. And so we don't think people really appreciate that. And then on top of that, the company is going to be running up against very tough comps this year because its largest customer is Peloton. And of course, 2020 was an absolute banner year for Peloton. And we think running up against that very tough comp environment is going to be a bit of a challenge for them this year.
Okay, great. Thanks everybody for tuning in. Thanks, Josh. And sorry about going a little overtime, but a lot of questions for Josh. Maybe we'll try to get him back later this week. Have a great day out there.